Hi, Jim. This is Mo. Thank you for all you do and the amount of research you do on our questions. I have a question around social index fund investing. I've been looking at the various Vanguard funds around this, and first starting with the VFTNX index fund for socially conscious investing. This is a fund that's been around since 2003. It has a $5 million minimum investment, so none of us are going to be investing in it, but it seems to have strong returns over the last 2 decades. In fact, when I look, I think it might actually be beating the total stock market index fund as well. And so I know I can't invest in this one, but I look at the one I could invest in, the Vanguard VFTAX social index fund, and that one's only been around 2 years or so. So would appreciate your opinion on how those two social index funds are different or how they're investing differently from each other versus similarly. Know obviously that crystal balls are going to be cloudy no matter what fund it is, but as long as the evidence is not pointing that these are so much worse, I think a number of docs and other folks might be interested in this route of investing ongoing. Thanks so much.
All right, good question. One I'm getting more and more frequently, whether you call them social indexes or whether you call them ESG funds, I think is the most common term these days. There's a lot of interest people have in promoting good governance and social equity and helping the environment while they invest. What are your thoughts on these funds and maybe those Vanguard offerings in particular, Ben?
Well, I like the idea of investing things that you feel good about because money should feel good when you're doing it right. Um, in this particular case, I think the reason there's been outperformance in the last 10 years is when you take the things that are socially icky, like oil companies, out of the index, then it's more concentrated in the things that have won in the last 10 years. So technology has been really hot in the last couple of years, and over the last 10 years, oil has performed poorly. And so if you drop that out of the total index to get this social index, then you're going to have a greater concentration of the things that have been working in the last 10 years. I don't think it has anything to do with the fact that this is a social fund and it's a good fund or a bad fund. I think it has everything to do with the sector exposure. Another thought is, let's say that maybe you're in your 401k and you don't have access to the social index, but you want to do something good. You're more or less forced to invest in just a straight up index. But, in terms of really making a difference in the world that we live in, whether or not you own oil is not going to make a huge difference because those companies are going to be in existence. They're going to trade on the exchanges, whether you like it or not. They're out there. It's your investment in a fund is not going to change that because these securities already exist. What will change is if you become actively involved in a charitable organization where you go and you use your own hands or you use your own money. Maybe take the money that you make in the index, maximize the amount of money that you're going to make, and then go donate that to charity or donate time to charity. Get actively involved. You'll make a far bigger difference there than you will by messing around with which share class you have and whether or not they're socially performance.
Yeah, I'm not a huge fan of social investing, and it's not that I don't like the environment. I don't like bad governance or social causes. Part of the issue with these funds is it's hard to find one that lines up with your thoughts on all of these hot political topics.
Mm-hmm.
You might not care about oil, but you care about guns. Or you might not care about guns. You might be the biggest NRA supporter in the country, but you really want to see, corporate managers held to their tasks. And it's really hard to find a fund that actually lines up with your beliefs. I think that's challenge number one if you want to do this. And challenge number two, I think, is what you mentioned, that it doesn't make that big of a difference. And I think you're far better off earning money as best you can, perhaps not, starting your own company that, you're against, but certainly investing broadly in the U.S. market and then using your money to donate to the charities that you support. That's what Katie and I do. We don't try to, have fancy social index funds. We just have boring old total stock market funds, and then we donate to charity, both with our time and our money. So yeah. I'm not a big fan of social index fund investing. The good news is I think the data a number of years ago was that they substantially underperformed. More recently, it looks a little better. I agree. The reason for that is that they're heavier on tech stocks than they are on more value companies, which have underperformed over the last decade. but maybe they're getting better at actually providing reasonable returns. I think the governance factor in particular is promising in that regard.
I wouldn't expect that outperformance to keep going. I mean, it's one thing to go and talk to your congressperson in person and talk with them about how you feel about these positions and issues and to be actively involved. It's another thing to not use a straw, because it's made out of plastic. I mean, really, I think it's okay to invest socially, but don't use it as a cop out. Use it as something that's added on top of the other activities that you're pursuing to actually make a change rather than just feel like you're making a change.
If you want your questions answered by the White Coat Investor, record your question at whitecoatinvestor.com/YQA or click the link in the description.
My dad, your host, Dr. Dolly, is a practicing emergency physician, blogger, author, and podcaster. He is not a licensed accountant, attorney, or financial advisor, so this podcast is for your entertainment and information only and should not be considered official, personalized financial advice.